after the FOMC, we're catching Peter Hug, Global Trading Director for Kitco. Peter, thanks so much for being with us.
You're welcome, Daniela.
As the markets continue to digest the minutes from the FOMC, Peter, what are your thoughts on what came out of it?
Absolutely nothing came out of it.
So we took you away from fishing for nothing, Peter.
Yeah, I'm still on my holiday, and I was going to go trout fishing today, and I figured this might be worth coming in for to give some input. But on my blog, which I wrote last night, actually not this morning, I just don't see them doing anything until they've got economic data to substantiate it. And they parroted the same thing they've been saying for the past 6 weeks, and that's show us economic strength, and we're prepared to taper. And I still think the jury's out on when they're going to taper. I'm still in the camp that it won't be at least until the end of the year, possibly 2014.
Well, there seems to be an alignment with Bernanke's tapering timeline, though, right, Peter? There seems to be a consensus.
Well, the consensus is, but if you listen closely or you analyze what Bernanke said, it's premised on certain events occurring. Unemployment rates improving, inflation staying below 2%. All of those things are premised on Bernanke's timetable. And, I think he's worried about the housing recovery. And if you look at the equity markets over the past 10 days, they have not been behaving very well. And, that's where he's trying to build the wealth and to give the consumers the confidence to go out there and spend. And, if those two primary components, the housing market and the stock market, start to weaken, I just can't imagine that the Fed is going to start to tighten up on monetary policy. It's totally counterproductive.
But let me ask you this, Peter, because this is what I partially understood from it. You said if they get the good numbers that they'll cut back on their bond buying program. But from what I understood, the numbers don't even need to be that good.
But even if they do, the fact that they're not going to be buying $85 billion in bonds a month, you can make an argument that that's actually tightening. But they're not going to all of a sudden just stop the bond buying. It's going to be, that's why the word tapering is used. I think they may do 20 billion a quarter. And if you extend that out, that's going to take at least a year for the tapering just to end before there's any type of possibility for interest rates even to rise.
But Peter, how important was this meeting ahead of the Jackson Hole Symposium that begins Friday?
I'm going to have to go back and listen and reread the Fed minutes, because I did not get anything out of the Fed minutes today other than their party line, which is if economic strength starts to develop, they will begin to taper. I think at Jackson Hole, there may be some more definitive timelines and more definitive amounts that they're going to taper, but I don't think they said anything in the last minutes that is relevant to this market.
You almost seem frustrated, Peter. It's almost like you wanted them to say something of substance.
No, I honestly didn't think they would say anything of substance. This is not rocket science. You've got to look at the economy. I'm looking at the economy. I'm not seeing an economy that is accelerating here. And over the last 2 weeks, the stock market has been taking it on the chin, and the housing market, at least permits, have dropped because the 10-year bond is approaching 3%. That in and of itself is going to slow the economy. Now, you add the Fed to that by decreasing its bond purchasing. I just don't see the Fed doing that.
Okay, Peter, so when you wake up tomorrow morning, let's talk gold now. What impact do you think it will have on the yellow metal, if any?
Well, I think on gold, I think the underlying premise that created this move up from the mid 1200s was primarily a thin market in August, and the bulls scared the heck out of the shorts and traded it up through ranges. They used the argument that the Fed will continue to pump money into the economy. Now, if that is the only leg gold has to stand on, and this pumping of $85 billion in bond purchases is not creating an inflationary surge, which I am not seeing anywhere. In fact, we're fighting deflation in my mind, not inflation. I'm skeptical on gold's continued strength here, subject to no more serious geopolitical risks in the Middle East. But this may have run its course. Around 1,400, I'd be very, very nervous, this market, because there's no intrinsic reason for gold to be at $1,900.
All right, Peter, before I let you go, I'd like to bring up another news item that caught my interest today, and that was Ron Paul, former Congressman Ron Paul's investment portfolio. So we saw today that it's dedicated almost solely to hard assets, with 64% in gold and silver miners, 20% in real estate, and 15% in cash. Peter, is this the craziest portfolio you've ever seen?
No. And the reason I say it that way is because every portfolio is premised on first of all, what your belief is that the economy is going to do. When I look at Ron Paul's portfolio, it indicates to me he believes that the dollar is going to continue to weaken, and he is worried about an inflationary surge coming from all of the stimulus that has occurred since 2008. Now, if he's correct, and we do get this inflationary leg, where you want to be is in hard assets, such as real estate, such as precious metals, and obviously you want a portion of it in cash for just for liquidity purposes. But he's betting on an inflationary spiral developing because of this easing policy that has occurred since 2008. And in that context, his portfolio makes sense.
Does your portfolio echo the same thing, Peter?
Well, I'm not going to tell everybody out there what my portfolio consists of. I mean, first of all, portfolios need to be designed based not only on your risk tolerance, but also on your age. And, if I was 30, I'd be much more aggressive in my portfolio holdings than I am at the age of 62. So, I'm not going to discuss exactly what I hold in my portfolio.
All right, I'm not asking you to. I'll let you off the hook, Peter. I'll let you get back to your vacation.
My point was going to be, I'm going to see my barber in about 2 weeks, and I'll find out what his portfolio is, and I'll ask my plumber next door. I mean, the fact that Ron Paul has this belief is fair. That doesn't mean he's right. I am much more comfortable. Again, depending on your age group. If you're younger, you can afford to take more risk. But if you're middle age or older, like I am, you want to be a bit more conservative. And I tend to be more on the balance side. So I'll give you percentages. I'd be about 30% in equities and not speculative equities, solid equities that pay dividends. And I'd be about 30% in hard assets, of which 25% would be geared towards real estate, 25% in cash, and the balance of 15%, if my math is accurate, in medium-term bonds, no more than 2 to 3 year maturities.
Okay, I thought you were fishing for a compliment before. Thanks, Peter, for your thoughts today.
You're welcome.
And thanks for watching this edition of For Pete's Sake. Hope you enjoyed it. You can email us at newsfeedback@kitco.com or follow me on Twitter @Daniela Camboni. Thanks for watching.